Good morning. I think last class we covered inflation. We covered, yes. Types of money also we covered. So national income completed, money, inflation, types of money. So probably today's class will try to focus on monetary policy, financial market. Both are very much important for prelims. So probably if you look at tools of monetary policy were regularly asked by UPSC. If you look at PYQs, probably themes from monetary policy, they're asking quantitative tools and qualitative tools. Very basic question. What are quantitative tools? What are qualitative tools? Sometimes they're asking, so relationship between money supply and money multiplier concept. So apart from that, if you look at in monetary policy, probably tools are there: repo rate, reverse repo rate, CRR, SLR, SMF, SDF, open market operations. Open market operations also is very most repeated theme among the quantitative tools. Sometimes they're asking incremental CRR, each concept. Then qualitative tools. Why quantitative tools are more effective than qualitative tools? So which of the following is a quantitative tool, which of the following is not a quantitative tool? Then in the recent times, many questions are being asked from MPC, Monetary Policy Committee. So probably there is a new tool called SDF, Standing Deposit Facility. So again, if you are following geoscientist exam, UPSC geoscientist exam, RBI UPSC is indicating a new trend. So in asking economy questions, the new trend is giving numbers and asking you to find out. So earlier they used to simply ask what is CRR, what is SLR. No. Now they'll give the number and you have to find out what actually is the CRR. So which means if concept is clear, you will be able to answer. Last year prelims also, fiscal policy budgeting deficit, they give the numbers: revenue deficit, fiscal deficit, effective revenue deficit, primary deficit. Meaning, okay, you studied, use your brain and find out the answer. That's what they're trying to tell. Probably in this year, repo rate, reverse repo rate, CRR, SLR also, they might give the numbers instead of just directly asking what is the meaning of the word. So, but what is the objective of monetary policy? Who is responsible for monetary policy? If you look at, to control inflation, to achieve price stability. Price stability is controlling the prices when prices are increasing, regulating the prices when prices are falling. So to achieve this price stability, we need to focus on demand as well as supply. So very simple logic. To control inflation, suppose if you want to control inflation, to reduce the prices, you can take two measures: demand side measures, supply side measures. So how do we reduce the prices? Either by increasing supply or by reducing demand, or combination of both of them. Because prices are influenced by two fundamental factors. What are the two fundamental factors? Supply and demand. Prices are increasing because supply is less, demand is more. So when can we regulate the prices? When can we control the prices? You can increase the supply or you can reduce the demand. But look at supply side. Can you produce immediately? So whatever goods that we are talking about, can you increase the supply immediately? No. So we are trying to reduce the demand, because you need to understand what is the relationship between money and expenditure. If you have more money, you will spend, or if you have less money, you will spend. Both cases you will spend. But what happens to expenditure when more money is there? Increases. So what is the relationship between demand and money? Directly proportional. More money, more demand. Less money, less demand. So look at first week of every month, how you will spend? More money, so more demand. Last week of every month, no money, trying to manage. So if money supply is more, what happens to demand? Demand would increase. So this is the logic of monetary policy. What is the logic of monetary policy? To control the prices, we have two options, either increase in the supply or reduce in demand. But supply you cannot increase suddenly just like that. So we are trying to reduce demand by making public postpone their consumption, by making public postpone their essential consumption by reducing money supply. In simple, if money supply is more or money is more with the public, circular flow of money, more economic activity, more demand. If we reduce the supply of the money, the less the economic activity, less the demand. So to control inflation, supply side measures are focused by the government under fiscal policy. Demand side measures, through money supply, we want to reduce demand, which is prepared by RBI. So this is the link to inflation. So to control inflation, we can take supply side measures also, we can take demand side measures also. Supply side measures are taken by government, which are called as fiscal policy measures. What are supply side measures, sir? Importing from wherever it is cheaply available, enhancing productivity, providing incentives. Look at now what's happening to LPG cylinders. So Government of India has invoked Essential Commodities Act 1955 and stepped up LPG production in all oil refineries. Hoarding of the cylinders is a punishable offence. And we are just not dependent upon only Gulf countries for bringing our LPG needs. We are trying to negotiate with the other countries as well. So these supply side measures are taken by whom? Finance Ministry. Whereas demand side measures are taken by RBI, which is called as monetary policy tools. So what is the objective of monetary policy tool? Through monetary policy tools, we want to decrease money supply. When do we want to decrease money supply? To reduce demand. So to control prices, to bring inflation under control. Because Urjit Patel committee recommended, how much is the flexible inflation targeting? 4% plus or minus 2%. Meaning, if inflation is beyond the threshold means more than 6%. Let's say inflation is 9.5. So to bring it down under control of 2 to 6. So to bring it under control of 2 to 6, we have to reduce money supply. So demand, when money supply decreases, what happens to expenditure? Expenditure decreases, demand may come down, prices may come down, inflation may decrease. If inflation is within the range of 2 to 6, if inflation is under control, we focus on GDP growth rate. So how do we focus on GDP growth rate? By increasing money supply. When money supply increases, obviously expenditure would increase. Demand is expected to increase. So because demand is expected to increase, production starts increasing. So what might happen to GDP growth rate? So entire monetary policy tools, whatever we are going to cover, is based on this principle. Which means whether inflation is under control, go for increasing money supply to increase GDP growth rate. If inflation is beyond the threshold, go for decreasing money supply to control inflation. See, look at what I am saying the word. What is the relationship between money supply and demand? Money supply and demand, what is the relationship? Directly proportional or directly relationship? Yes, because the more the money supply, the more the demand. So what is the objective of monetary policy? Increasing money supply, decreasing money supply. Adjustment of money supply. Why are we saying the word adjustment of money supply? Because sometimes we'll increase money supply, sometimes we'll decrease money supply. That's why adjust money supply. Look at the word. Adjust money supply meaning sometimes we'll increase money supply, sometimes we'll decrease money supply. When will we increase money supply? When inflation is under control, to push GDP growth rate, we'll increase money supply. When will we decrease money supply? If inflation is not under control, it's beyond the threshold limit, then we try to reduce money supply. So these called as monetary policy tools. And in this monetary policy tools only, so we have so many tools, quantitative tools, qualitative tools, all this. But if you list out all quantitative tools, probably what are quantitative tools, what are qualitative tools? So repo rate, reverse repo rate, CRR, incremental CRR, SLR, MSF, SDF, OMO, open market operations. So these are called as quantitative tools. And there is something called qualitative tools. So name itself says you can estimate change in money supply with numbers. That's why that's called as quantitative tools. Margin, moral appeal, so credit regulations. So these are qualitative. Qualitative means you cannot pinpointedly point it out exactly how much money supply is changed. So something which you can estimate is called as quantitative. Something which you cannot estimate is called as qualitative. So what are these quantitative tools? And each tool meaning you supposed to know, plus what to do to increase money supply, what to do to decrease money supply. So if you look at, so in quantitative tools, whenever we talk about, we need to understand if inflation is not under control, what to do. If inflation is under control, to increase GDP growth rate, what to do. So if you just understand one part of it, remaining all are same only. So what is repo rate, sir? Repo rate is the rate at which commercial banks will provide loans for short-term purpose. Meaning, for less than 1 year, if a bank is in need of financial mismatch, it borrows from RBI. So that is called as repo rate. So whenever we talk about repo rate, so you need to understand probably how repo rate mechanism works. Repo rate is the rate at which RBI provides loans to commercial banks for short-term purpose less than 1 year. Now in India we are following something called floating interest rate. Floating interest rate meaning when bank is giving loan to customers, we are telling that interest rate is not fixed. This interest rate is linked to policy rate called as repo rate. Meaning, if you take a loan from a bank, bank will say, sir or madam, today the rate of interest for the loan would be this much. But it's not fixed. It is subject to change whenever policy rate called repo rate is revised. Meaning if repo rate is increased, interest rate also would increase correspondingly. If repo rate is decreased, interest rate also would decrease. This is called as floating interest rate mechanism. How, sir? I will tell you. Suppose SBI is taking 1000 crore loan from RBI. So RBI is giving at 5% rate of interest. ICICI is taking 20,000 crore loan from RBI. RBI is giving at 5% rate of interest. This is repo rate. Repo rate refers to the rate at which RBI provides loans to commercial banks. Now, when SBI is fixing interest rate to customers, it considers something called marginal cost. Sir, what is the meaning of marginal cost, sir? After a bank borrows from RBI, till it provides loans to the customers, all the expenditure that is incurred is called as marginal cost. What is the meaning of marginal cost, sir? Let's say, for SBI, employee salaries, rental expenditure, administrative expenditure, profit margin, we call it as spread. All this is called as marginal cost. It's like SBI has taken 1000 crore loan from RBI. Now SBI is planning to give these loans to public. So when SBI is giving loans to the public, what is the additional cost incurred by SBI? Marginal, extra, cost, expenditure incurred. So SBI borrowed from RBI at 5%. Marginal cost is say 1%. So interest rate is fixed to the customer as 5% is repo rate. Marginal cost 1% plus profit margin 0.5. So finally SBI is giving at 6.5% rate of interest to the customers. And what did we say? SBI borrowed from RBI at 5% only. But why is it charging 6.5% from the customers? To recover marginal cost and to get the profit. Similarly, ICICI is taking loan from RBI at repo rate. However, for ICICI, marginal cost is different. Marginal cost means again operational expenditure, salaries, employees, profit margin, all. So ICICI is charging 7.2% interest rate to the customers. So I said something, two words, floating interest rate. What's meaning of floating interest rate? Whenever repo rate is revised, interest rate to customer is also revised. In fact, a mail is sent by a bank that, sir, we are happy to inform you that repo rate is increased. So the interest rate on your loan is also increased. Repo rate is decreased. So interest rate on your loan is also decreased. So this is called a floating interest rate. Marginal cost means additional expenditure incurred by the bank after it obtains loan from RBI. Marginal cost vary from bank to bank. Marginal cost vary from bank to bank. Profit vary from bank to bank. That's the reason why interest rate vary from bank to bank. Banks are not social service organizations. Every bank needs some profit. Yes, spread, that's called as. Why SBI offers loans at low interest rate? Because relatively profit margin is low compared to a private bank. Marginal cost also different. Profit margin also different. Why, sir? Because it's the nature of the bank. See, public sector banks are able to offer loans at relatively low interest rate. Why? Because they are public sector. Which means they are also profit oriented, but not completely like private commercial bank. That's the reason why. If you take a housing loan from SBI, SBI will offer for 6 to 7% probably. But if you take same loan from ICICI, 9 to 10%. Why? Profit margin difference. Profit margin also vary. Marginal cost also will vary. That's why interest rate is vary from bank to bank. Okay. Actually, in banking terminology, we call it as spread. Profit margin means spread. SPREAD, spread. Spread is called as profit margin for the bank. Oh, let me repeat, very easy only. So repo rate is the rate at which RBI provides loans to commercial banks. And each commercial bank will provide interest rate to the customers. And while giving loans, the commercial banks are saying we'll follow floating rate of interest. So what is the meaning of floating rate of interest? Madam or sir, we are giving loan to you today, but the interest rate is not fixed. Interest rate is subject to change whenever RBI revises repo rate. So every bi-monthly monetary policy, every once in 2 months, when RBI revises repo rate, interest rate to customers also keeps on changing. Increase also decrease. That's why that's called floating interest rate. Sir, why interest rate vary from customer to customer, from bank to bank? Answer is simple. Repo rate is same, but marginal cost is different, profit is different, profit margin is different. So if you understand, this is called as repo rate. If RBI increases repo rate, so you look at, if RBI increases repo rate, what bank does with the interest rate to customers? Because floating interest rate. If RBI increases repo rate to a bank, meaning bank has to pay more to RBI, what bank does with the interest rate to customers? Increases. So if you look at how repo rate mechanism works, when RBI increases repo rate, correspondingly, bank is also increasing interest rate to customers. When interest rate to customer is increasing, what happens to borrowing? So if more interest rate, people will try to borrow less. So when borrowing decreases, what happens to money supply? Money supply decreases. When money supply decreases, what happens to spending and demand? Then what happens to prices? So inflation may come down. If RBI increases repo rate, what is the impact on interest rate on consumers? Interest rate on consumers also is increasing because we call it as floating interest rate, marginal cost. Earlier, housing loan was available for 7%. Now same housing loan is available for 10%. If rate of interest is more, we would borrow less. So obviously borrowing would decrease. Money supply may come down. Same thing if RBI reduces repo rate. So whenever we talk about, so when RBI reduces repo rate, banks also will reduce interest rate to customers. So because of which what happens to borrowing? Borrowings is expected to increase. Money supply is expected to increase. When money supply is expected to increase, we are spending more, because of which demand is more, we have to produce more. So obviously what would happen to GDP growth rate is expected to increase. So logic is simple. If RBI increases repo rate, what is happening to money supply? If RBI increases repo rate, what is happening to money supply? Reduces, because in the market, people who are borrowing got decreased. When RBI reduced repo rate, what happened to money supply? So what is the relationship between repo rate and money supply? Inversely proportional. If you have just understood this logic, so in this table, if inflation is not under control means not in the range of 2 to 6%. So if inflation is at 7.8, which means should we increase money supply or should we decrease money supply to control inflation? Inflation is 8.5, means more than 6%. To control inflation, should we increase interest rate or should we decrease interest rate? Increase interest rate. Why, sir? Because inflation is not under control. Inflation is not under control, meaning it is not in the range of 2 to 6. So inflation is 8.5. To control inflation, to control the prices, should we reduce money supply or should we increase money supply? Reduce money supply. If people spend less only, demand would come down, prices would come down. To reduce money supply, what should be done with the repo rate? What RBI does with repo rate? Will it increase or will it decrease? So RBI increases repo rate. When RBI increases repo rate? When inflation is not under control. Suppose when inflation is under control, to increase GDP growth rate, should we increase money supply or should we decrease money supply? So to increase money supply, very simple logic. To increase money supply, to reduce money supply. So if to reduce money supply, we are supposed to increase repo rate. So to increase money supply, what should we do with the repo rate? We should decrease. So that is the logic of monetary policy tool. So if you have understood when RBI increases repo rate and why, when RBI decreases repo rate and why, that's the logic of why are we dependent on repo rate. So how questions are asked, sir? Is repo rate same for all the commercial banks? Is repo rate same for all commercial banks? Repo rate is same for all the banks, whereas interest rate to consumers is not same for. See, repo rate is same for all the banks, whereas interest rate to consumers is not same for all the banks. Why, sir? What is the reason? Because marginal cost and profit margin vary from bank to bank. So this is the logic of called repo rate. under quantitative tool. First one, repo rate. Sir, why is repo rate seems to be more effective tool in adjusting money supply? Because it is directly influencing credit availability to the public. Credit availability means the funds available as loan. That is the reason why we are dependent on repo rate as effective tool for adjusting money supply. So once you know this,